Hello. My name is Josiah Higgins, and my database research project is on which grocery stores are the most financially stable. And I choose to look at Target, Walmart, and Kroger. And I used a variety of financial ratios, liquidity, leverage, activity, and profitability ratios to do that. And I put together some graphs toward the end to kind of illustrate my findings. Okay, my initial hypothesis is that Walmart is the most financially stable company and Target is the least financially stable company. I came to this conclusion because I believe that Walmart is the biggest company and the most reliable, and Target is probably the smallest. They don't have as many streams of revenue as Walmart and Kroger, and for these reasons, they're probably going to have less cash reserves and possibly use more debt to finance their operations. So we're going to start with Walmart. Who are they? I'm going to do this in order of three companies. So I'm going to do Walmart first, and then Kroger and Target, and I'm going to go over who they are, their strategy, each ratio, and then after I do that for every company, I'm going to show the list of graphs, or I'm going to show a bunch of graphs that I have put together for each, and then my conclusion. So we're starting with Walmart. Who are they? Business was first conducted by their founders in 1945 with Sam M. Walton and his brother James L. Walton. Uh, They opened their first Sam's Club in 1988 and their first Super Center. I'm sorry, their first Sam's Club was opened in 1983 and their Super Center was first opened in 1988. They are an omni-channel international retailer, meaning they have many different streams of revenue and they are international. They do e-commerce, in-store, and they have gas centers through Sam's Club. They serve approximately 240 million customers each week in all 50 states. And they recently sold their Argentina branch. They have around 23 international segments. And like I said, they just sold their Argentina branch for around, I think, $1 billion, dollars, which is going to throw off the 2023 numbers a little bit. They have 2.1 million employees globally, about 1.6 million in the United States. The US is their largest operable segment globally. They are listed on the New York Stock Exchange as Walmart. They're currently trading as of Friday, November 29th at $92.50. Their market cap is 743 billion and they pay dividends of around 83 cents and have increased every year for the past 51 years. What is their strategy? Their mission statement. Their strategy, this is coming from their management discussion and analysis section of the 10K. Their strategy is to make every day easier for for busy families, operate with discipline, sharpen their culture, and become more digital and make a competitive advantage. Making life easier for busy families includes their commitment to price leadership, which has been and will remain a cornerstone of their business strategy, as well as increasing convenience to save their customers time. Their motto is save money, live better, and they define their financial framework as strong, efficient growth, consistent operating discipline, and strategic capital allocation. While brand name merchandise accounts for a majority of their sales, they have both leveraged US private brands and developed market specific brands to serve their customers. Some popular ones you might have heard of are Equate, George, Great Value, Holiday Time, Mainstays, Market Sides, and Parents' Choice. They have taken certain strategic actions to strengthen their portfolio, primarily in the Walmart International segment. They have three reportable segments: Walmart US, Walmart International, and Sam's Club. The US is their largest segment. Like I said before, they operate in all 50 states. They have 600 stores in Texas. It's, I think, the largest amount of stores they have in a single state. They bring in around $1.1 billion annually. A single store, I'm sorry, one single store brings in around $1.1 billion annually. That comes to around $3 million a day. They had net sales of 420.6 billion for fiscal year 2023, representing 69% of their fiscal 2023 sales. Net sales of 393 billion in 22 and 370 billion in 21. Their pricing and merchandising strategies, um, they absorb cost increases, and instead of passing those cost increases to their customers, they reduce, eh, I'm sorry, instead of passing those cost increases on to our customers, they like to focus on keeping prices lower than their competitors, and that goes by their saying, low everyday low prices. Um, this tends to lower their margins a little bit because they do eat those costs. They will increase prices a little bit, but tend to keep them lower for competition strategy purposes. So moving on to liquidity ratios, their current ratio, working capital ratio is zero point 0.8. Their ability to pay their short-term obligations is pretty good. Grocery stores do it a little differently, so their current ratios are going to be less than one a majority of the time because they are going to have different credit terms with their suppliers. For example, Walmart oftentimes will take payments from customers before they pay the suppliers for the inventory, and this is going to create a lower current ratio. But that is a pretty good working capital ratio for grocery stores. Their quick ratio, I like to look at this better for grocery stores. Their ability to pay their short-term obligations with their most liquid assets because they're they hold most of their assets and inventories. They don't hold a lot of cash. So the quick ratio is going to be significantly different for that reason. Their net operating working capital, again, like how efficiently their company uses its working capital, the current assets used in day-to-day operations to generate their sales. So they have around 5 billion of that. I didn't do working capital for any of these ratios because uh, it's all going to be negative and very different for it's going to fluctuate a lot, but a majority of the time it's going to be negative because they don't hold a lot of um, cash, and uh, due to their fast inventory turnaround and um, delayed payments to suppliers, the working capital is going to be negative, which is usually a bad thing. However, in this instance, it's really not because they're grocery stores and it's different from every other uh, segment. But grocery stores are going to have lower working capital ratios. So Walmart's leverage ratios, their total liabilities to total assets is 0.65. Between 3 and zero point 0.6 is ideal. For every dollar of assets, the company has 65 cents of debt. That's pretty good for a grocery store. I think this is going to be a little low compared to Target and Kroger. By the way, all of these numbers are an average of 5 years. So I did 2019 through 2023 individually and then averaged all of the numbers, and that's what I'm presenting on here. I'm not going to go through all of these for time's sake. However, I'll just pick out a few. I just did the total liabilities. Total debt to total equity. They don't tend to use a lot of debt to finance the operations. They use more equity. Like Kroger and Target, they tend to use more debt. Walmart keeps more of their they have better credit terms with their suppliers, and for that reason, they don't hold as much cash because they can use the cash from selling that inventory to pay for that inventory. So they don't need a lot of debt. Total debt to total capital at 0.39, total debt relative to their total equity. This is actually less applicable to grocery stores given the low amounts of cash held by them. However, this still shows that they're using less debt relative to the amount of capital that they have. Their activity ratios, operating cash receipts at 156 billion 263. They're generating a lot of cash from their core business operations. That's a really good thing you want to see. And Walmart doesn't decrease at all from 2019 to 2023. Their total purchases increases a lot, and it's almost half a trillion. Or no, I'm sorry, that's not in billions. That's total on a year. So 442,000 total purchases of inventory. It's increasing every year. They're selling more goods each year, so that's very normal to see. Their profitability ratios, their gross margin is pretty stable where it should be for a grocery store. Their receivables turnover is pretty good. Their collecting the receivables 79 times a year, and their inventory turnover is really fast for such a big store. They're selling all of the inventory they stock around 8 times a year. That's really good for such a large company. So some non-GAAP earnings. They have a return on investment of 14.9 and 12.7 from 22 and 23 respectively. The decrease came from a decreased net income due to restructuring charges and an opioid settlement of around $1 billion. Free cash flow was 12 billion, 11.1 billion, and 25 billion for 23, 22, and 21 respectively. Moving on to Kroger. They were founded in 1883. They were built on the foundation of their retail grocery business with the added convenience of pharmacy and fuel centers. They operate a variety of different store names. A majority of their stores are not under the name Kroger. It's around 16 different names. Um, as of February 3rd, Kroger employed nearly 414 full and part-time employees around 35 states across the country. Their fiscal year ends on Saturday, closest to January 31st, and they are listed on the New York Stock Exchange as KR with a current price of $61.09 per share and a market cap of $44 billion. Kroger's strategy. They have a loyalty program that accounts for nearly 95% of their annual sales. Um, Their brands play an important role in their merchandising strategy and represented over $31 billion of their sales in 2023. Their supermarkets, on average, stock over 12,600 private label items and are primarily produced and sold in 3 tiers: the high-end brand, Private Selection, the mid-tier brand, the Kroger brand, and Simple Truth, which is their health and organic options. They also have 20 years of investment in data science capabilities, allowing them to create personalized experiences and values for customers, and is also enabling their fast-growing, high operating margin alternative profit businesses, including their data analytics services and their third-party media revenue services. Moving on to the ratios, their liquidity ratio is going to be a little bit less than Walmart. I'm sorry, their current ratio is going to be a little bit less than Walmart. I think the industry average is about 1, so this isn't out of the ordinary. However, because they are so heavily grocery, it's going to be a little lower because of their credit terms with their suppliers. Their quick ratio, again, they're with their most liquid assets, they're going to have a better ability to pay their short-term obligations than Walmart has, I think, probably because they're holding a little bit more cash than Walmart does because they don't have as good credit terms with their suppliers. Net operating working capital is lower than Walmart at 2 billion, and net operating working capital to sales is around, well, they working capital is around 9%. of their sales that they're getting from that to put back toward the company to reinvest. So that's pretty good as well for the retail sector. Their leverage ratios, again, I'm not going to go through all of these. However, I just calculated them. One thing to point out, they do use more debt than equity to finance their operations. Walmart tends to use more equity, so at 1.93, you can see that they're using more debt than they are self-financing their operations, which is okay. It's just a different strategy than Walmart uses. However, that is a pretty significant use of debt over equity at almost 2. Um, Total liabilities to total assets at zero point 0.8 is good. You don't want that to go above 1. They're holding more assets than their liabilities, but that number is higher because they use more debt to finance their operations. Their activity ratios, their operating cash receipts is, I think, that might be, it's a lot, well, it's actually a lot lower than Walmart. Um, but they're generating a lot of revenue from their core business operations. That number isn't too far off from the revenue. Again, these are averages for 5 years, but this number isn't too far off from where the revenue would be each year. Their purchases, total inventory purchases are consistently growing every year. It's a growing company, so again, that's going to happen. Um, at 110,000 purchases, they're moving inventory pretty quickly. Profitability ratios, their gross margin is lower than Walmart at 0.22. That might be because their loyalty program, where 95% of their sales are coming from that, so they're going to be making less money on per dollar. They're very efficient at getting their inventory turned over. As you can see, they're cycling out new inventory or old inventory and replacing it with new inventory around 15 times a year per store, or yeah, around 15 times a year, which is significantly better than Walmart and Kroger. They're very efficient at doing that. And I think this is what puts this company in above Target and Walmart. They take the cake on inventory turnover. Some non-GAAP earnings. Um, they are 7.2. Their return on investment 7%, 9%, and 9% again in 21, 22, and 23. Less than Walmart because they order inventory. They're ordering significantly lower amounts than Walmart would, which will raise the cost of goods for them. And free cash flows are 4 billion, 5 billion in 21 and 22. So for Target, their goal is to uh, let's see, help all families discover the joys of everyday life. They operate as a signal segment designed to enable guests to purchase products seamlessly in their store. Stores make up around 96% of their total sales, and they have around 400,000 employees in all 50 states. They're on the New York Stock Exchange as Target, or as TGT. Current price is at $132, and their market cap is at $6 billion, and they pay annual dividends of $4.48 dollars per share. Their strategy is relevancy. They aim to expand their target's relevancy in their consumer lives by driving traffic, sales, and market share growth. They want to make it easier for you to differentiate Target from their competitors. Their brands, they have a significant amount of brands in the retail, grocery, apparel and accessories, home furnishing and decor, beauty and household essential, and hardline um, products. They have brands in all of those. Some you might recognize: Goodfellow, Room Essentials, Threshold, Universal Thread. They also utilize Starbucks. They buy the license to Starbucks to operate in their stores under the Starbucks name, and which means that baristas in Target stores are actually Target employees. And they also have a loyalty program with credit cards, debit cards, MasterCards, and Red cards. They have a partnership with TD Bank to supply the cards. Some liquidity ratios. They have a higher current ratio at 0.95. That's going to be better than Walmart and Kroger. They're just able to pay their short-term obligations a lot quicker. And their quick ratio is a little bit higher as well. Again, better than Walmart and Kroger. They have more liquid assets. They have more cash on hand at all times. Their net working capital is 2 billion, net operating working capital sales at 9%. They're getting a lot of working capital out of their sales that they're able to reinvest back into their business. Not going to go over all of these. They have something I would like to point out. Total debt to total equity. They do use more debt than Walmart, but less than Kroger to finance what they're doing at 1.27. They have enough cash on hand to take out more debt to finance their operations. However, they still do have a lot of equity. They have more equity finance than Kroger. They pay significantly, or they pay a lot in dividends. They're known as a dividend king, and Kroger doesn't pay any. Um, Total debt to total capital, they have not a lot of debt compared to the amount of capital that they're putting back into their business. This is a good thing. They're a mature company. This is going to help them keep growing. They have a lot of operating cash receipts at $30 billion dollars. They're generating a lot of business, growing each year from their core operations, and their total purchases are also increasing at an average of $75,000 per year. Their gross margin is higher than Kroger pretty significantly, and Walmart a little less significantly, but this is a really good margin to see for Target and grocery stores in general. Their receivables turnover is pretty high, and their inventory turnover is a little bit low compared to Kroger and Walmart. Um, but considering the size of the stores compared to what Walmart is, it's still pretty good. They have less inventory to turnover. So they're a little bit less efficient than Kroger is and Walmart. Some more non-GAAP earnings. Their return on investment in 21, 22, and 23 was 22%, 20%, and 11%. Free cash flow was 7.9 billion, 5.1 billion, and negative 1.5 billion in 2021, 22, and 23 respectively. The negative cash flow in 23 was a result of significant reinvestments into the company's supply chain and business infrastructure as a part of their strategy to open new stores and update existing stores. These are some charts to point out some liquidity comparisons. They're pretty on par for their current ratio. Walmart has a little bit lower of a quick ratio. Target has the best. This is just to point out Walmart's average net working capital, to point out they don't use a lot of cash. They have better credit supply terms or credit terms with their suppliers. Their average gross profit margin is pretty stable too. Kroger definitely has the lowest, probably because um, they around 95% of their sales are with the loyalty card, which is gonna, drive down prices for their customers and costs for them for each product. And Kroger has a significantly higher average inventory turnover, as we can see here. My conclusion is that Walmart is the most financially stable and Kroger is the least financially stable, not Target. Um, Target just has, they're more efficient, they use less debt, they have more cash. Walmart obviously has around 500 billion more dollars in operating cash receipts than all of them and is very efficient at collecting from their customers and paying to their suppliers. And for those reasons, I come to this conclusion. Thank you.